Stocks are definitely an excellent long-term investment, but you have to know what you're doing. We all know stock market is a good long-term investment, but you need to be cautious while employing your hard-earned money. The idea is to get yourself educated before investing, where you should be aware about the pros and cons of it, as the goal is to achieve long term wealth and retire comfortably. So let's dive into today's topic: why do people buy stocks? Hi, my name is Sunny, and I make content that affect a common man financially. If you're new to this channel, please subscribe to it alongside smashing that like button, as it will help me with the YouTube algorithm, which of course will be highly appreciated. The main reason people invest in stocks is to make money, plain and simple. Stock buying is like owning a proportionate part of that company that hopefully will be worth more in the future than it is today, which is called capital appreciation. As a shareholder, you have the right to vote on corporate matters while receiving dividends, which are your share of the profits generated that are distributed to shareholders very regularly. Another reason is that dividends provide passive income, especially for retired investors or those no longer working. There are many things that you need to consider before buying stocks, where the potential for higher returns is worth mentioning. Additionally, stocks are an excellent way to diversify your portfolio from other asset classes, thus reducing your overall risk. Timing the market while buying the stock is next to impossible, but there are a few things that you should keep in mind. First, market timing is next to impossible as there are many economic indicators and world events that can affect the stock price. Hence, there's always a chance that the stock market will outmove you. Second, don't get affected by the stock market fluctuations, which are quite normal. If you have a long term horizon, the market historically goes up. So, if you are patient, you are likely to see investments grow with time. Third and most important, don't take your eyes off your long term goals, which is to invest for your retirement. It is easy to get discouraged when the stock market drops, so it's essential to keep the long term goals in focus while ignoring short term fluctuations. Generally, it is easier to get in at the beginning of a long term uptrend than to get out at the end. That is why many investors will be caught holding stocks when the stock market takes a downturn, leading to significant losses. When buying stocks, there are many things to consider, like the type of stocks you're looking to invest in, your budget, and the risks that are associated in such investments. Once you have decided, the next step is to open up a brokerage account where you will place an order to buy stocks, and the most common one is the market order. This means you are willing to buy the stock at whatever price it's now trading at. Of course, you need to transfer funds into your trading account before placing the buy order. You also need to know the fees for buying and selling stocks, as most brokerages will charge a commission for each trade that you make. Stock investing is risky and may not be for everybody. You should know three main risks: market, corporate, and interest rate. Market risk involves the overall stock market going down for many reasons, so naturally your stock investments will likely lose value. Corporate risk involves a specific company that could fail or even go bankrupt. There could be multiple reasons behind it, like poor management or competition coming up with compelling products or services, thus, you could lose your investment. Finally, the interest rate risk. Here, rise and fall of it could potentially change the profitability of the company you invested in. Their bond values fluctuate and you might end up losing money. Investing in stocks can be a good investment as they generate high returns over long term, giving a sense of ownership in a company while allowing you to receive dividends as a shareholder. Such passive incomes come in handy if you plan to retire early. Moreover, they also offer diversification benefits as they tend to perform differently than other asset classes like bonds and real estate. In fact, they allow you some preferential tax treatment over other classes of investments, when it comes to reporting your profits. On the negative side, they are more riskier than other types of investments. Market downturn can be volatile, leading to significant losses if you are not carefully monitoring your portfolio, which potential investors should be aware of. But that is me, I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not even a financial advisor, so please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.